There is one thing that affects everybody's investments on this planet. It doesn't matter if you live in Europe, Asia, or North America. This one thing is absolutely going to impact your portfolio. And when this price starts falling, it has a very good track record that the stock market really starts accelerating to the downside. Stick around, I'll show you what it is. Hey everybody, RC Peck here with Fearless Wealth. And there's just one thing we're going to talk about today. And it's important because it actually affects everyone, whether you're in stocks or bonds or cash or commodities. It's that underpinning momentum that moves all markets over the globe, not just in the US, but the whole globe. And that is the federal funds rate and whether they're increasing it or decreasing it. I'm like, not that exciting, but let's do this. Let's jump right to it. I'm recording this close of market on Tuesday. This week in the US, it is Thanksgiving week that starts Thursday. So it's a very, very busy week for me. And I'm doing this early to get this out to you to make sure that I have a video for you to watch. So here we go. Let me jump over to the price charts and let me show you what we got here. And what I want to do first is let me move my picture over here. Okay, so super simple. The top part of the price chart or the top price chart is just the S&P 500 index. That's it. Just the S&P 500 index, no dividends reinvested, nothing, just the index going back 30 years. The bottom price chart, or the bottom half of the price chart, is whether the Fed is increasing or decreasing their federal funds rate and what they're increasing or decreasing it to. Everyone's talking about the Fed pivot and we can't wait. What I'm sensing is we can't wait until they start lowering the rates. And if they pivot, so first couple things, the Fed's not going to pivot. They're raising the federal funds rate to 5%. And they've been very clear about that. The market really hasn't believed them, I think, up until recently. So right now, the federal funds rate is at 4%. It's going to 5.25% at the most. So that's the bottom half of the price chart with the line going higher. Okay, and I know the line just says 3 something, but the federal funds rate is actually at 4% now. They give it a range, so it's like 3.75 to 4%, but it's at 4%. Okay, so what I want to show you in this video and just what I want to talk about is one specific thing. Generally speaking, specifically speaking, over the last decade, what has happened to the stock market when the Fed starts lowering rates? And it's really clear. So let's first go back to 2000. The Fed stopped raising rates. And if you look at the screen, I'm going to put 2 blue vertical lines on this. The Fed stopped raising rates on the left blue vertical line, and they stopped at the right. Between those 2 price charts is the dot-com crash, which lasted 30 months, and the S&P fell 50%. So the reason the Fed starts lowering rates is because bad things are happening in the economy. And they're like, okay, we got to start lowering rates and make borrowing better for people. So the lowering of the rates by the Fed is actually not a good sign. And it's what started, or the Fed started lowering rates because of the dot-com crash. If you then go over to the global financial crisis, which started in 2007 and ended in 2009, the Fed did the same thing. They dropped rates from a pretty high rate. So I didn't say what they started in the dot-com, but in the global financial crisis, the rates were at 5.25% and they dropped them to 0. So they dropped them 525 basis points or 5.25%. And during that time period, the S&P fell 58%. Now, if you look at the right blue line, you can see that the market actually kept falling even after they stopped dropping rates. That was Bernanke saying, uh-oh, I better start printing money, quantitative easing. And that's where the trillions started getting printed, because just dropping rates to 0, which had never happened before, was not enough. And then if you go to 2019, when rates dropped from 2.5% to 0, from the beginning to the end of that, from the rates going from 2.5 down to 0, the market fell 25%. Now, the market first went sideways and then went up and then really fell hard. But from where it started to where it ended, the market fell 25%. So right now, the US and basically the world is in this process of all the central banks around the world raising rates. Typically, that's good for markets. Markets are like, hey, raise rates. the Fed raises rates because things are good. The thing is now, rates are now getting up to that 4 or 5% for U.S. Treasuries 2-year, U.S. Treasuries 1-year. They're not at 5% yet, but they're getting, they're very solidly in the 4%. That is giving people an option, which they have not had an option against the stock market for 2 decades. So a lowering of rates is not going to be a good thing for the stock market, historically speaking here, right? It has been a place where the Fed's like, okay, we need to make things much more accommodative for people. So to wrap this up in this one idea, the raising rates, the market, it's not doing well right now, right? And those are when the Fed is raising rates. It's typically when the Fed starts lowering them that the market really starts getting hurt. I said a few weeks ago, expect a end of year rally. I believe it's happening and is continuing to happen. So do not, be surprised if we have a continued, as I talked about a few weeks ago, a year-end rally, which is happening. So let me know where you think I got it right, where you think I got it wrong, what I missed. Please like, subscribe, and leave a comment. It makes a difference to the algorithms. Even if you say, hey, RC, nicely done, or I like it, or have a good weekend, those comments matter. And what it does is it helps this video get out in front to more people. And I want to make sure that happens, and I appreciate all of you that are helping. So thank you for that. If you're curious about how to retire strong, that's what we do at our company, Fearless Wealth. We want our clients to retire strong. Everything about retiring strong has to do with your portfolio and the strategy behind your portfolio. If you've been in my world for any amount of time, you know that I believe the 60-40 portfolio is something that was invented in the 70s and has been needed to be updated for quite some time. The size of your portfolio is what matters most. When you retire at 65, you all know a $5 million portfolio is going to be much better for the last third of your life than a $2.5 million portfolio. Or a $2 million portfolio is better than a $1 million portfolio. Or a $10 million portfolio is better than 5. You know the point I'm making. Here's the thing. Financial advisors look at portfolios and how to keep them strong lastly. They literally back into it. We start with making sure you have a strong portfolio and that it's the biggest it can be in a safe, accelerating way. We call that to retire strong. If you're curious, super simple. You can just email us at hello@fearlesswealth.com, or you can look at a link in the description. Thanks for being in my world. For everyone who is celebrating Thanksgiving, by the time you see this, it would have already happened, but it is Thanksgiving weekend. And I appreciate you being in my world, and I look forward to speaking with you soon. Okay, bye.